Okay, there. Got the high sign that it's record. We are recording, and it is the Ides of February, February 15th. Hope you guys had a good Valentine's Day. I am Tim Quast. It's a 2024, just in case this lasts a while. February 15th, 2024. And Brian Wilson is with me as well. In my screen, it's upper left. You know, it may depend on where you are. He's market strategist, and we're going to divide and conquer this. We'll split it in two. He's going to go first. We each have things to cover.
Thank you very much, Tim. Good afternoon, everyone. Fantastic to see you all again. As Tim mentioned, I have 3 or 4 points to discuss today. My last point will kind of dovetail with Tim's. Maybe I'll bring that one up last, and then Tim can kind of add to it. So let me go ahead and share my screen. I wanted to start, this is my backyard, by the way. Don't I wish, right? I wanted to start with a SPY review, and I'll show you what I mean. I dropped components of the SPY just into a spreadsheet a couple of weeks ago, and what I wanted to show you here is just a reminder how heavily weighted it is towards the large names. So and here's the weighting: Microsoft 7.25%, Apple 7%. And if you go down to, and I stopped this at 50 basis points, and you can see that is 51%. So 51% of the SPY is just in 36 names. And if you look at just the larger ones, the top, I believe it was 14, just going down to 1% weightings, that's 36% of the SPY. So just a reminder how heavily weighted these constituents are. How can you potentially use that to your advantage? One item that I'm doing, and maybe many of you do something similar, just toss them in a screen. So I've been tossing them. I just use Yahoo Finance. There's a million different ways to track these, but just track them on a daily basis is what I would recommend. And you can see right now that a good number of them are actually under a little bit of pressure. Today, first day of options expirations, many of these moving in a very similar manner with today's trading. That was actually different than yesterday. Most of them were up. Apple was an outlier yesterday. When I saw that, I was curious, and I'll show you how you can use it. Even if something isn't in one of our portfolios, you can always go take a peek at it. So yesterday I noted that Apple was down, and what I did is I ran something very similar to what you're looking at right here. I wanted to check the demand and supply for Apple. Demand was rising, so demand was in good shape. Supply was actually below the trend line. Supply was in good shape as well. When Apple moved, I think it was all the way below its intraday volatility yesterday. And what I mean by that, let me go ahead and show you. Go to the big tech portfolio if you want to see those components of, let's call it the Magnificent Seven. You'll find them right here. And you can look at intraday volatility for all of those different names. You can see normal intraday volatility for Apple was 1.3. If I remember correctly, I think I bought it yesterday when it was down 1.5, 1.6, something like that. So in other words, it had lost all of its normal volatility. As long as there's not news in the name on a given day, as long as nothing else, Wednesday with the CPI announcement that had everybody down. But as long as nothing extraordinary is happening, this gives you a really good idea for potential buying spots or entry spots. So I bought Apple down its intraday volatility. It moved higher by 40 or 50 basis points, and I just sold it by the end of the day. And I actually used an options trade on that one, and same principle as just taking that 40 or 50 basis points, but I was actually able to make over 30% on that trade. So if anyone's, interested in what I was doing, give me a holler, but it's basically just using the principles of intraday volatility. I was looking to potentially hold it for 1 to 5 trading days, to get that 50 basis points to, 1%. Since I got it in one day, I just went ahead and took that profit. So once again, I just wanted to cover that SPY review. And I would just advocate maybe adding some of those names to a watch list. They are such an important part of the market. And as they move, they're generally going to move the market. So just advocate for doing that. I did mention in the note today that I recommended not trading momentum names today. Why would I do that? Well, I dropped the momentum names into a portfolio today, and you can see the movement with today's names. About half of them lower, about half higher. Meanwhile, the broad market is breaking out. Well, if it's a momentum portfolio, why wouldn't that be breaking out with the market doing really well? Well, we're in the middle of options expirations. Market participants are making decisions today regarding a lot of these names. They might be taking profits in some of these names today. Perhaps they're not renewing some of the leverage that they were employing during the course of the last month. There's various reasons why they might come under pressure. But if you're looking to trade during expirations, just realize that you can have sometimes this type of activity happen to you. You can have a perfectly good name. Let's say with net, I don't know if it's down its intraday volatility. It might be close. Let's say it's down its intraday volatility. You buy it, and maybe it doesn't do what you were expecting. Well, recognize that we're in the middle of expirations, and you have outside forces that are potentially acting on shares. And that's why I recommended today, if you were looking to, pulled up the wrong one. If you were looking to potentially watch names today, to look at the low volatility portfolio, which you can see is right there. And most of them are doing a little bit better than the momentum portfolio today. So that was low volatility. Wanted to show you one other way you can use Edge, just looking at your dashboard and setting up potential portfolios. And just two examples here. Take a look at AI. So I just set up a representative list of companies under here. I don't know if I captured them all, but captured a lot of them. The point is, you can set up these portfolios with whatever you think should be in it. But if you look at my AI portfolio right now, you can see that basically demand has stayed above neutral since the middle part of January. And you can see, especially during the last couple of weeks, that tremendous short covering that's been in the space. Well, you would expect AI stocks to do better, and they certainly have. If you look at Bitcoin, same principle. Demand going above neutral the latter part of February, basically staying above neutral. If you're 5 or above, that's going to generally support higher equity prices. Look at that tremendous short covering in the space. You have divergence, you have greater demand, you have less supply. That's going to support better Bitcoin prices, and it certainly has, with Bitcoin moving higher here over the course of the last couple of weeks. So just a couple of examples of how you can use that. You can slice and dice these portfolios, however you wish, whatever groups that you want to monitor. I did want to take a minute here, my last point today, kind of talking about the broad market setup, and this can kind of dovetail into Tim's discussion. I think he wanted to touch on this point as well. We'll start with really the first thing that I look at every day. It's just the broad sentiment for risk management. For those that are new to the platform, this is the S&P 500. What we are tracking is what we call broad market sentiment here in green. Think of that as demand, and supply down below. Think of in short volumes or supply down below. What we're tracking coming into expirations is sentiment or demand is flattening out. It probably bottoms today and starts rising again. Once again, whenever you have sentiment that is over 5, that tends to support higher equity prices in the market. Right now, we're at 5.2. You can see that short volumes have been moving lower. You think to yourself, wow, 50% short volumes, that's extraordinarily high. Perhaps the average for the last year, 49.8%. So it's actually right in line with where we have been during the last year. The point is that there's a lot of borrowing of shares just for normal market operations. Brokers don't hold as much inventory as they once did. So we are just generally tracking higher short volumes over time. We'll definitely let you know if we get into areas where, short volumes, start to become a risk. Right now, they're right in line with where they are normally at. Wanted to share a couple of other things. So that look right there tells us that demand is bottoming during expirations. Short volumes are coming in. That's a good look for higher equity prices. I have a look here. I just call it my all equity portfolio. I'll show you what that is here. It's literally just all the market caps. So small cap, mid cap, large cap, and mega cap. That's going to capture basically all the companies that we have in our database. And what I wanted to show you with this portfolio, you can see that we are once again moving higher. So demand is up and short volumes are below the recent trend line right now. That supports advances. And two other areas to show you in terms of the broad market setup. I wrote about this morning. This is the only ETF that we track in our system. The reason for that is ETFs are essentially derivatives, and we don't want them messing up the system, if I can use that term. But what we're tracking here, and I'll give you a little bit of a longer term view, is the fact that SPY short volumes are once again moving lower. I say once again because the average for SPY, if you go back 6 or 7 years, it's about 55%. On a 1-year basis, it's about 55%. We had tremendous short covering at the end of the year. It was a little bit of an outlier. You can see how low short volumes got. At one point, they went down to about 40%. Stayed low for a very long period of time. And you can see just during the last week, they started to increase. And this is part of the danger of looking at one data point because it doesn't become a trend. We saw short volumes increasing for SPY across the market. In my head, I thought, maybe this trade that we've been tracking that has supported, very good gains for the SPY, maybe that trade is ending. Well, we see just as soon as those short volumes went higher, they immediately have gone back lower. And as of today, they're down to 44.5. So they're once again moving well below trend. We don't know if this will continue. Once again, it's not a trend right now. It's just a couple of days of trading. But based on these couple of days, this might be a continuation of what we saw early January through most of January, which did help to support gains across the market. So with that, Tim, I think I will end my part of the conversation.
All right. Thank you, Brian. Appreciate that. Well done. And the reason, by the way, if all of this is new and somewhat confusing to you, it's probably not to the folks who are here routinely. But if it's all new to you and you're just kind of overwhelmed, the reason that we track these things is that, particularly these big picture views that Brian is talking about, is because the market is very uniform, and it's not by accident. It is by design and by behavior. And if you think about what you do with your long-term investments, it's probable that a lot of that follows models like a target date fund in your 401k, where depending on your age, you will have a modulated exposure to, I'm just oversimplifying, equities and fixed income. And that is the prevalent behavior in retirement accounts. And it has caused, it's not the only reason, but there's been if you look at the long-term trends, and you can go do this research. There's you can look at the Investment Company Institute and look particularly at their annual fact book. We track that data, and I'll make these comments short, that the trend away from stock picking and toward passive investment models like asset allocation, a 60-40, or whatever your blend is, mine's less than that. I'm more exposed to bonds than equities in many of my longer term. They're managed accounts. Other people look after those things, but I certainly weigh in. And in fact, I said in the last month, I would have preferred that we reduce our exposure to equities and bonds, both. And it's because of this, and I'll show you at the end, the long time that we have spent above 5. My point is, the market is not full of stock pickers. Stock pickers have lost $500 billion a year for 15 years to BlackRock, Vanguard, and State Street. That will absolutely have an effect on the way that the market behaves, because they're after two different things. Stock pickers are after outliers, outperformers. Passive money wants the herd. They're the exact opposite. And so as the money that wants the herd, the average, you could call it beta, gets larger and larger and larger, things hew to the mean. And then the whole structure of the markets today, it's a time priority market. We talked about it in that, somebody asked that question at the webinar yesterday. So prices, stocks have to trade between the best bid to buy and offer to sell. They can't be the same. Forces stuff in between those two. What lies between them? The average price. So if the whole market promotes average prices and all the investment flows want the average price, what will happen? Averages prevail. And so this is a good lead into what I'm going to talk about. What I want to talk about are mechanics and probabilities. As I mentioned to you folks who attended the webinar, so that's what I'm going to talk about. And the mechanics and probabilities are based on understanding volatility. There are other terms for the thing that we call volatility in the platform. I'm going to share my screen and I'll explain here. And I forget what it is. Pam, I don't know if you're here, but you know what that term is. And I can't recall right off the top of my head. There data abounds. But I'm going to use this as the example. Bear with me here. So if I look at, this is the stocks comprising the S&P 500, all kinds of ways to look at this data. But I just want you to look at one thing. Okay, so this is data today. So here is the average intraday volatility, which we measure as the average high and low price. And we do rolling averages for that data, so we can understand how much things move. So the average stock in the S&P 500, if you look at the 5, 20, 50, 200-day averages, call it 2%. The 50-day, 2%. Stocks on average move 2%. Well, that's not by accident either. Mutual funds that say this fund tracks this index. If you don't track it within 2% variance, you get in trouble with regulators. They'll say, well, you're misrepresenting yourself if you don't track that thing. Well, then you got to keep rebalancing. If a stock, like if Lyft goes up 35%, and it's part of a basket that I'm using to be within 2% of an index, I'm going to have to get rid of Lyft, because now it's causing tracking errors. Outliers are terrible for passive investment. So while we love to see these big gains for stocks, it is counter to what passive investment is trying to do. But in this is a trading advantage. Once you understand, okay, what is the money doing? Well, most of it is tracking a model and it doesn't want outliers. How volatile is it? Well, about 2%. Why? Because machines set most prices and they're the most risk averse participants in the market. That's why you watch a stock and it's going up and then it goes down. What's responsible for that? Well, machines with a much narrower top and bottom than you have. That's what you see throughout the day. That's why we say 1 to 5 days is better. Do I expect my stock to produce a return today? Depends on the supply and demand balance. But oftentimes I buy late in the day for the return tomorrow. Because now I have another shot at what machines will do, and I know how much they move things. In the S&P 500, about 2%. Now, how about in and I don't know if I have this up, so we'll see. Yeah, don't. Okay, but I am going to talk about that. Then you take SPY, which Brian was talking about. It moves half that, about 1%. Why? Because it's much more elastic. ETFs have shares constantly created and redeemed, unlike stocks. Now, there can be buybacks. There can be incentive plans for executives that increase the number of shares outstanding. You could do a stock offering that increases the supply of shares outstanding. You could split the stock to increase the supply of shares. But generally, the amount of stock for a company stays fairly constant, whereas ETF shares are constantly being created and redeemed at the pace of $560 billion a month. ETFs are creating and redeeming ETF shares. Investment Company Institute data. Okay, so that factors into the mechanics to understand how to trade things. If I know that SPY and the underlying stocks have about 100 basis, a huge spread between them, then I can go 1, 2, 3. What's the first thing? SPY, very elastic, least volatile, 1%. The underlying stocks, 2%. Now, let me go look at something that I might want to trade. That's the final step in the process. And so if I go out here and it could be momentum, could be, I'm just going to stick to what's on the platform here. I'm going to go out here now and look at this and say, all right, how much does this stuff move? And I could go sort this. The volatility, the momentum portfolio, by the way, it has a set of criteria that wants stocks that move at least 3% per day, that are very liquid, so we reduce the risk. They tend to be larger. Small caps are very risky. You will not find me trading a stock that doesn't trade thousands of dollars per trade. The average stock in the S&P 500 trades 50,000 times a day. And if you want to know how many orders, 95% of all stock orders are canceled. So do the math on that. Hundreds of thousands of trades are being put in. A lot of those get canceled, and some part of them get executed. And the market is very illiquid and very volatile. Look at snow today. I had to, I closed out my position ahead of this demo because I just didn't want to sit there with it. But it moved to just my little position alone, 223 shares. I moved $1,000 constantly. It could be down 200. I only will risk a certain amount. If I'm trading $50,000, let's say, in a position, I'm not going to risk more than 1% of that. Moves 1%. I'm out. I'm not gonna risk it. Now I know what the math is, and I'm going to give you 3 examples because this is all about the mechanics. But I know what to do with snow. Snow moves 3.7%. Okay, if it's down 2% today, and I know that the supply-demand balance is good, this is the key. The key is, what do we know about what people are doing? With the caveat that, as Brian said, options are expiring today. Almost 20% of Snow's market cap depends on puts and calls. Now, most of that gets renewed because a lot of that is hedges. That's global macro money. It's long short hedge funds. It is classic 40 Act funds. So the Investment Company Act of 1940 permits mutual funds, pooled investments to commit up to 10% of their resources to something other than the prospectus says. That could be cash, could be derivatives. And we know, because we used to have one of these people on our client services team. This was a number of years ago. We hired him from BNY Mellon, and his job was to trade baskets of futures and options to true up tracking for index funds. That's what he did. Because why? They're less expensive, they're more liquid generally than trying to get all these little tiny pieces of stocks. Okay, well, that's going on. So most of it is going to roll unless there's some kind of event. If the Fed comes out and says we're hiking rates, all those derivatives get marked to zero. They get marked to market, and it can wreck the market. Right? That's why you have to be very careful at these points. But if I look at the demand supply equation, falling supply, strong demand, price moves around a lot. What is the probability that I'm going to produce a return? Well, you can calculate that. In fact, we're doing that. I'm going to blend point 1 and point 2. So here, this is a sneak peek, folks. We've been talking with you, veteran existing users, and telling you that we're about to provide some more information. And by the way, for those folks from Interactive Brokers, this is what we're integrating using iFrame with Interactive Brokers. We've been working on it. And we've worked very hard on this stuff, and it is, I have financed that. There's not one dime, 1 cent of outside money behind all of Edge. It is my capital that has built this thing. So this is what we're after. We're going to put on the platform the volatility. Don't worry about the formatting. This is rough. It's chiseled out and it's not smooth yet. But if I want to look at SNO, here's SNO. Here's its last close. Market cap, we're going to rearrange these. Volume, that's average volume. It moves 3.7%. We'll make sure that that's squared. And what is the probability that when these conditions exist, I can make 2% in the next 1 to 5 days? Well, this is the math we run. And the math says, well, there's an over 80% probability that I can, but I'm only after 2%. The beautiful thing is if you take 2% every other day, you will become rich. And your risk is very small. You don't have to say, oh, is it no money? Stock's way down, and am I going to get a big return? Don't have to do that. That's stressful. I don't, Selena, to your point, I'd rather be skiing. I'd rather know, okay, I'm going to take an hour to do this, and I produce my return, and I'm done. Done for the day. I go do something else. And if you can repeat that, not only do you have a lot of free time, but you have the high probability and confidence that you can produce a return. And producing small returns over and over, the market will give you that. That's the difference. Passive money wants an average that stays within 2%. Stock pickers want stuff that goes up 70, 100%, but they almost never beat the average. Less than 1% of stocks consistently deliver alpha, outperformance over the long term versus the risk that everybody else takes. Right? If we all take the same amount of risk, what is the probability that I can outperform you? Well, in the stock market, it's very small. With Edge, it's very high. It is. My portfolio vastly outperforms my managed accounts. But it's a trading account, different outcome. So I know I have an 81% probability. I'm going to discount that by at least 10 to 15% during options expirations, because I don't know what effect options are going to have on that. And then I can even know where I'm going to buy. I'm going to buy somewhere between 231.58. I actually got to buy at 231.37, which was even better. I'm happy with that. Somewhere in this range, looking 5 days out, there's a high probability I can produce 2%, which would be north of 236 on the lower end. Well, I'd be happy during these times to just take 50 basis points. It didn't happen today. I closed the position flat because I can't sit and watch it. And Selena, I was out I worked out with the trainer, and I was out. All I did was put in limit. I put no stop on it. I really wasn't worried about that. I wasn't worried that the stock's going to go down $1,000 on me because I know what's going on. I can see the supply demand balance in the broad market. I know what it is in SNO. I'm not worried about the downside. I'm worried more about missing the upside. Right? So I could have sold it up 40 basis points very easily, and I was even poised, and I didn't do it. Maybe I should have. But it's very high probability. And the mechanics come back to understanding the market moves 2%. SPY tracking the market moves less than that because market makers trade both. That's how they make money. How would you incentivize Citadel and Virtu and Susquehanna and GTS and Hudson River Trading and Tower Research and Infinium and so on to make markets in ETFs and stocks, which must follow each other if they didn't have a 100% probability of producing a return. That's why they do it. But Citadel is going to take a tenth to a half a penny. Well, you and I are probably not going to do that because we're not trading tens of billions of dollars. But if we could take a percent or two, we don't have to compete with Citadel. We don't have to compete with BlackRock. We don't have to compete with stock pickers. We have found our spot and we've stacked the probabilities in our favor by understanding why the market works the way it does. So a couple more examples, but that is the key. That's the whole Rosetta Stone here. And that's 19 years with one company, but call 20 plus years of thinking about market structure. I talked about Vertiv, one of Barry Norton's favorite stocks. So, I traded this on Tuesday when I bought it on Monday. And so I've got a position at 900 shares of this, so a reasonable position in it. And I have it on the day that the CPI data comes out. Now I realize that's risky. Could I? Is that the best thing to do? Well, it depends on your risk tolerance. I was very confident in this data. Very strong demand. This is price rising. This is demand hitting the ceiling at 10. It's been there for a month, right? It's a very strong demand, and supply is falling, and it took a huge divot right here. Well, what is the probability there that I'm going to produce a return? Well, in Vertiv, under these conditions, 100%. Now, past performance does not guarantee future outcomes, but statistically, I know over the trailing 90 trading days that every time these conditions existed, where supply fell and demand remained strong, that Vertiv delivered at least a 2% return in 1 to 5 days. Well, I'll take that, right? That's if you've got a poker hand that has a 98% chance of winning, you might push your chip stack in on it, right? And I'm not taking that kind of risk, but sure enough. And so Selena, I went skiing. I didn't worry. I didn't put a stop or limit on it at all because I already know where it trades. It was down. I mean, I was down on that position pre-market more than I prefer, but I was willing to do that under that circumstance, knowing that the news was out. And so I came back from skiing, an hour and a half later, and son of a gun, it was up 2%, right? Even as the Dow was down 700 points and Vertiv was up 2%, because the supply demand outweigh. They're more significant than price. That is why you don't trade price, you trade supply and demand. Price tells you nothing. Price is set by Citadel, which has this long an investment horizon. Blink your eyes, 400 milliseconds. That is how much time Citadel wants to take to produce a return. Well, my horizon is much longer than that, so I can't rely on the same thing they do. Citadel's worried about how much a price moves. I'm worried about supply-demand balance and how much the price moves, and can I take half of it? And that is the whole basis. Okay, so we're that summing up, and then we'll come around the last 2 minutes here to talk about the broad market. And I don't have a lot to add to what Brian Wilson did. He's very good at covering the broad picture. I will show you this. So this is broad sentiment. This is a reflection of BlackRock, Vanguard, and State Street. The top 7 money managers, 70% of the money runs on models. And here's, by the way, this is when monetary policy changed. So the market was screaming in 2021. That's SPY, and this green thing, that boom, 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 that when it's moving like that, it's a momentum market. And down here with supply, insufficient supply, very strong demand. It didn't even go below the green line until November. It's December. Didn't even go below the green line until December. This entire time, it's above that green line, which is sort of an entry point. But it also tells you that things are changing. And so supply was very deficient. And then wham, it wasn't. And so that's what happened when the Fed started hiking rates. And the move came before it because all the money adjusted in advance and went, we're no longer long equities, we are short equities. And so then all the way to here, there was a short bias. And what did the market do? It did very poorly. You could still make plenty of money trading with edge short term. The supply and demand imbalances always exist in bear markets and bull markets. And you don't have to worry about how a company's performing. You don't even have to worry about that. That's not what BlackRock buys. BlackRock buys a product that tracks a benchmark. So then it changed again, right? So basically in June of last year, people started to think, okay, the Fed's going to stop hiking. I mean, the interest rates play a big role in these global macro schemes. And so right through this period of time, we reflect that. I think this is the beginning of a breakdown of it, though. I don't know what's going to happen. As Brian said, if you look at the short term, that we've had a reversion to the mean. There is nothing that indicates that the market is about to fall apart. But we have stopped residing in this window where we had insufficient supply. In fact, this, if you look at SPY, and I'll finish with this, SPY, which Brian highlighted, that this dramatic move we had was tied to derivatives. As he said, there's been a huge move in supply. The move from here to here, one of the biggest moves down in supply in SPY we've ever seen. You could go back here, it's even bigger than the one in June of 2021, when we first got the breakdown, when the first indication that monetary policy was going to change occurred. So the question then is this the beginning or the end? And I don't know. It was the end here. And is it the end here? I don't know the answer to that. That's why we look at it every day to see what trend is developing. But it's very helpful because you can see in advance what all the money is beginning to do, not what all the pundits say. And I think we will call that sufficient. Okay, and then Richard, you had a question I wanted to answer. Oh, did you answer it, Brian? Okay, good. Anything I have missed? Okay.
Hey, Tim, it's John.
John, our data guru.
You.
Yes.
So you were looking at what you were just showing us was great, and you were talking about the Fed policy. I think either yesterday or the day before, you mentioned that rates aren't really having an effect on the stock market. It was the asset allocation shift out of tech into other stuff. Is there a way to see that on Edge, or could you go back and maybe show how we would use the dashboard to view that? Because I tend to agree with you.
Well, and I was on CNBC with Brian Sullivan back in August, and I contended. I said, look, it's not, interest rates aren't what determines whether money goes into tech. And his other guest poo-pooed that. May have even condescended to me. But not that I care about who was right, but who was right. Right? Clearly, it was not a factor because what has led the market? Tech. And I think, and how do you absolutely why? But really, you make a great point because this is where the market cap is. In fact, I'll even show you this: mega caps. There are 111 of them right now, which is more than 100 billion, and it is $35 trillion of market cap. Why do big stocks lead the market? Because that's where the money goes. If I'm BlackRock, I can't have something that has 500 million in market cap. There's no way that I can ever get enough of that. And you could go look at how many filings BlackRock makes to exceed the limits that the SEC puts on what you can own as an index fund. They have to file it because there isn't enough liquidity. There are only 3,000 public companies in the Russell 3000. They are 99.9% of market cap, but 95% is in the Russell 1000. So what drives the market is not interest rates or financial performance, it is size. And that is a fact that you can trace back mathematically to the money. And thus we try to trade size. We want to see when the money moves. And John, I think the answer is look at that. I mean, there's big deficiency in supply, very steady demand in mega caps, so the mega caps have gone up. When those things change, when we have the reverse of this, it's coming out. And that's what we'll look for. And you can see it in big tech too. Big tech did exactly the same thing. Deficiency in supply, very steady demand, as Brian Wilson pointed out. When that changes, and we'll see it, and it might be coming, I don't know. We'll just watch the data. That to me is what you look for.
So what
Okay.
one follow-up to that would be so our RSP, the equal weight S&P is up, like it's leading the market today, right? It's up like a 1.2%, and the S&P is just up, what it is. So basically the money's not going to the big stocks. It's, IWM's up too, Russell's breaking out, right? They're all at highs. I mean, could we see a shift in just from kind of more growth to value, and then knowing that the big stocks are still going to get their index flows, like could that drive this next leg of the bull market?
Well, so I would say the reason you see the equal weight outperforming today is all about options expirations. Is there a product that is collateralized that can support a basket? Well, there isn't enough in that narrow basket, so it spills into those other things. And keep in mind, the Russell 2000, two stocks are principally responsible for the outperformance of the Russell 2000. It's MicroStrategy and Super Micro, which will not be in the Russell 2000 at the next rebalance because they have exploded. But those two are responsible for like 85% of the outperformance of the Russell 2000. Be careful. And who are they? They're the biggest components now. And so that to me is the issue, John, and I'd be very careful about looking at what the equal weight does during options expirations. I'm curious what happens Tuesday. Tuesday, the new option series will trade. Now, is everybody really comfortable looking at the data? I would say yes, but I don't know. And what happens if just 5% of the participants don't renew their new options contracts when new options trade on the entire market Tuesday, because there's a holiday Monday? Well, it's very telling. Most of the big, not all of them, they're always out, but some of the biggest hits to the market in the market's history have occurred in the modern era on days when new options trade. I'm always very careful on those days. Okay, I've blown it. We've gone past 1:15 Mountain Time, but those were good questions. We can cut some stuff out of the replay to shorten it.
No, gentlemen,
Hey, Tim,
that's actually one of the best explanations you guys have ever given on Market Structure Edge. That should be a marketing video.
Why? Oh, thank you, Barry. That was our whole secret sauce right now there. Underneath that we have machines that measure how trades execute. That's how we get supply and demand. But that is the essence. Thank you, Barry. Appreciate that. Okay. Great to see everybody. We'll do it again next week. So, IBKR folks, come join. It's we have vigorous discussions about this stuff. And there are people in this meeting who are a lot smarter than I am. I just know a little bit about this data. Okay, you guys, good to see you. Thank you very much.
Thank you.
See you guys.